We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Well, hey, everybody. Welcome back to the Greenlight Retirement Show. I'm your host, Brian Lindbergh. We got Tim and Corinne Fitzwilliams.
Hello.
How are we doing?
Doing good.
Awesome.
Doing
hey,
great.
Ron. How are we doing down there in not so sunny Florida today? A little overcast?
Hey, guys. Well, yeah, it's a little bit overcast. It changes, off and on, but it's still a very nice, balmy 82 degrees here. So
Beautiful. I can't wait to relocate down there.
I'm curious, what type of turkeys did everyone do?
Turkey?
Yeah, what type did you do?
Just oven roasted.
Oven roasted?
Turkey. Yeah, not fried, just oven roasted. Nice pan, dress it up all right, get the broth in there and all that fun stuff.
Cool. What about you, Ron?
yeah. So normally we do like a 4-day process for a turkey that we
Oh, wow.
brine and then smoke, and it comes out this amazing thing. But because we're semi-displaced at the moment, we're doing renovations and living in an apartment, we couldn't do that this year. So I got stuck with eating somebody else's turkey.
So you're taking your turkeys as serious as you do your stocks. You're like, you got it all planned out.
There you go.
And I know
go.
Corinne tried
Very
something different.
important.
What did you do? You like karate chopped it or something, right?
Do you know what kind of turkey we did?
No, you did
Yeah.
something to it. You like
So if I wasn't here, you wouldn't even be able to answer the question?
no, you hit it with a
It's called
hammer or something.
spatchcock.
Yep.
Spatchcock.
Oh, spatchcock. Yep.
Yeah, so I did that for the turkey, and then
That's where you broke down the thing and
yeah,
squished it.
I did some chiropractic care on her, and
That's chiropractic, I forget what they call it when you cut it out, but
Yeah.
something.
but it so one year, a long time ago, back when I was a vegetarian, I was making my first turkey ever, and I don't know the difference between the bottom of a turkey and the top of a turkey, so I cooked it upside down apparently.
Yep.
So then when Tim's mom and my sister noticed and they went to flip it so it would brown on top and look pretty, everything kind of fell out of it because it was so moist and it was cooked upside down. So by the time they set it on the table, it looked like just a carcass. It was just the bones and all the meat had fallen off. So, but it was the moistest turkey ever.
You
So
boiled the turkey.
basically, so I liked the idea of spatchcocking it where it all lays flat, and then you don't end up with as much dry meat, and it worked out really good. But I was just making sure I didn't cook it upside down this time because I was like, I'll never live that down.
Yeah, there you go. Well, hey, as a refresher for everybody as we transition into the financial topics of today, that this is informational purposes, educational purposes show for you here today. Investment advice might sound and look and feel like you, but it's not you until you give us a call and you come on in and you get it. A full overview from us and our team. But to kick us off, we really wanted to talk about news. One of the things that's been out there is tariffs. Like, tariffs have been around. I think it was April 2nd. They really started becoming a thing other than just a conversation. And now there's real conversations about, can tariffs actually reduce the deficit? Are we going to be able to have potentially less taxation at the income tax level, so that because other countries are, being tariffed to bring their goods to us to sell them to us. So we wanted to table this for conversation over our turkey here. So Tim, you want to get us going on economics and tariffs and kind of lead us in here?
It's interesting. Like, can it work, right? Because at some level, we like to say that regulation is indirect taxation. So someone has to pay us somewhere. And I was really keeping a watchful eye on Black Friday and Cyber Monday and whatnot. It didn't seem like the tariff has been transferred to the consumer, really. I didn't notice that. I mean, there was still sales, and I'm talking about imported goods like Lego, for example. I mean, I didn't notice that there was a major change. It all seemed kind of the same. So I think, like we talked about before, I think the companies are still absorbing it. But there's a breaking point, right? So if you continue to raise it, at some point it will snap, and then the consumer will feel it. But can it reduce the deficit? Yes, absolutely it can. But is there a cost to it? Yes. Like nothing is for free, right?
Mm-hmm. That's right. Now, Ron, I remember a few episodes ago or shows ago, you had talked about you had sort of quantified that, and I hate to put you on the spot with this, but you had come up with a figure that's something to the effect of only 20 or maybe 30% of the tariff was being passed through to the consumer. Could you refresh us on that a little bit?
Right. Yeah, so that's a great question. I just actually did a little more of a deep dive in researching that. And there's a lot of different sources out there that give different answers. You go to the Fed, you get one answer. You go to the Yale Budget Lab, you get a different answer. You go to maybe some consumer protection agencies, you'll get a different answer. But the best that I could come to is that at present, it looks like businesses are passing on as much as 50% of the tariffs to consumers at this point.
And that's 55 right?
Yeah, 50%.
50%. Wow.
You have to remember that it started earlier, and it's kind of a one-time adjustment. So it's not an ongoing increase. Like every month we're seeing prices go up and prices go up. So it's a little bit less obvious as we get farther away from the moment.
Sure.
But and in the midst of this, of course, we have negotiations going on all the time where people are coming in and negotiating with the administration and lowering their rates. So there's a lot of that going on. But the research that I did said, it's more like about 50%. And it's likely that that's over time going to increase as, these companies want to keep passing on their costs. So there is that distinct possibility.
Yeah, and that kind of goes back to what Tim was saying here earlier, is that, hey, if these things do persist, eventually the company can't not be profitable, right? These are, machines. People get their salaries for making the machine as efficient as possible. It's their job to drive the most value for the common shareholder. And so they don't think necessarily about the individual consumer purchasing. Now, Tim, you made a comment. I'd like to ask Corinne this because anecdotally, I was looking around the holiday shopping, Thanksgiving, Black Friday, Cyber Monday, things like that. What I felt like I noticed, and love Corinne's opinion, is some of the places that were offering discounts weren't offering the same level of discount as they were in years past. I recall, I think it was Target used to give you like $20 cash back for every 100 you spend, and now it was 20 for every 120 that you spend. And so obviously that's a decrease in the amount of a rebate, but were you finding consistencies in that, or were you seeing that prices are about the same as you feel they were last year?
No, the prices are definitely increasing, and it's interesting to hear Ron mention that right now it's about 50% of the tariffs being passed on, and that it could go up, because what I noticed is, places like Target, they raised prices and pulled the price tags off.
So
you didn't know that the prices were raised until you were at the register, or if you're busy and you got 3 kids in the cart and you're not paying attention until you get home and you're like, why did I spend $250 at Target? So I think that the price increase definitely has happened. And then especially on Black Friday, I'm a Kohl's and JCPenney shopper, and I remember back when it would be like $15 for one of these like 10 different types of kitchen things. Sure. Like you could get a rice cooker or a toaster, and it was like $15 per appliance on Black Friday. You don't have those kind of deals anymore where it's like mass discounts of like 50% off. So I feel like there's definitely a difference in price and a big difference in the sales. A lot of the items that were on sale, even like for Black Friday on Amazon, Tim and I had them in our cart and the price had gone up a couple days before, and then they brought it back down.
Sure.
With it saying 30% off, but we're like, it's not 30% off. You just increased the price 30% last week. So, because we did a lot of our shopping before Black Friday.
Yeah. I feel like my wife was telling me the same thing, that she noticed they removed the stickers. And I think a lot of stores are going away from the sticker on the item, and they're going to those digital placards where they can change those things a lot more efficiently from the back office. And I can appreciate that from an efficiency standpoint. My mom actually used to work at Target, and she was the one who re-stickered everything and put the clearance tags on it all. And so those digital things can provide efficiency, but it's also sneaky because they can change the prices on you pretty quickly. Now, Ron, as we talk about the consumer discretionary sector, if you will, I feel like I recall conversations of companies that have reported earnings this or reporting third quarter in the fourth quarter, that they were projecting a weaker holiday season because of the consumer and because of some of the inflation metrics. Is this something that you've had your finger on the pulse of, and have you been paying attention to consumer discretionary versus consumer staples and things like that right now?
Yeah, it's really an interesting time because we have almost, as you've heard before, we almost have two different economies. And, you've got the top 10% of income households that are almost they almost don't care what the price tag is.
Sure.
They're just going to go out and buy stuff because they can and they want it, and they're going to get it. That's really holding up the sales of the consumer discretionary stores, and giving them some good numbers. Now they're putting some things that are good numbers, but their forward guidance is coming in a little bit lighter. And so there's some concerns that, going forward, maybe the consumer's not holding up in 2026 like they did in 2025. But at present, for this season so far, from a reporting standpoint, from a data standpoint, it looks like the consumer's holding up pretty well.
Okay.
Now, I will say, we were walking at a mall last night here in Miami, Coral Gables, and it was a ghost town. There was nobody there. And I saw that as a sign of caution that, wait, okay, we're maybe Cyber Monday, whatever Tuesday after Cyber Monday is called, but, it was eerily quiet. So it makes me wonder if that spending is.
You're definitely in a more affluent market where those shifts can definitely happen. Corinne, did you make it out to any stores this holiday shopping season?
So I didn't make it out for Black Friday, but Tim did. He made the mistake of purchasing something that had to be picked up in person, and he had to go to our local mall, Lynn Haven.
Yeah.
And he came back and he was like,
It was crazy, yeah.
Yeah.
But so I'm thankful I didn't have to go with him to do that pickup. But I went to Kohl's a couple days after.
Yeah.
And it was pretty busy in there, but it wasn't nearly as busy as I would have expected. And I think another thing is like at Kohl's, they have the thing where you can order online and you walk up and they've got like a whole section that used to be closed that's now just baskets and baskets, and you check your phone and it's like your stuff's in 128 and you go to 128, you grab your bag, you don't even have to check out, you just walk right out. So I think there's a lot more people doing that versus actually walking through the store. And I think because of that, you have a lot less of the impulse buying, because when you're purchasing off the internet, you're going for a sweater and you just buy a sweater.
Sure.
Versus when
That's a good point.
when you're walking through Kohl's with their little cart, you want a sweater, but then you see the little kid shirts, and then you see the
Socks are on sale.
and you end up spending far more. So I think that it's going to have some sort of an impact.
I think in some ways that part almost already has, because Kohl's, for example, correct me if I'm wrong, but don't they have Sephora inside them, which is typically a standalone retail store? Target has Ulta inside of it. Kohl's, I think,
I noticed
also
that
has
too.
Toys R Us inside of it. So maybe lack of impulse items is, they're finding ways to sublet some of their spaces effectively to generate similar revenues.
I hadn't thought of that. Yeah.
But I don't know, Ron, any comments on that? That was just a shot out of a cannon observation that I was thinking about. But
yeah, that's an interesting way of looking at it, and you may be right. But they're
can you tell my wife
whichever
that?
way it is, they're
just record
whatever way it is, though.
Get a soundbite there.
Record and play that over and over and over.
We'll get that.
They're certainly seeking for ways to augment their revenue stream. So that says something in and of itself, that they're having to find some way to bolster their brick and mortar sales in some way.
Yeah, I think because of competition, right? So you got to be cautious, right? If you have tariffs that you're competing with, and everyone else has tariffs you're competing with, you're not, slashing prices is going to hurt, but raising prices hurt more. So maybe you're trying to find as many things you can possibly find and come up with to insulate your profit before you pass it to the consumer. Sure. And I think it makes perfect sense. If people are subletting, making these agreements, then that's just one more thing they can do before it has to pass to the consumer. So that also tells us then that we're getting towards the end of the games and smoke and mirrors, if you will, and passing to the consumer is going to become a reality in a real way here very soon.
That, or it's going to be Target, Walmart, and these major retailers turn into consignment shops for all the mid and lower tier retailers.
Well, Walmart already has that. When you shop on Walmart.com,
this is true.
80% of the things there are not actually Walmart.
Yeah,
it's sold by third-party vendors that have.
Target's kind of similar as well too.
I don't like that at all, though.
Yeah.
Well, it's consolidation, and so that it needs.
But you don't know what the true retail price is.
Well, yeah.
That's the problem, especially if you can't go to the manufacturer and they don't have the MSRP and they have some agreement.
So
now you're like, well, what's the deal? What's supposed to be the price? You need a standard at some level.
Yeah, and marketers have been great with that because all I think about is price anchoring and MSRPs and things like that when we go there. What I'm hearing through this, though, is it's actually going to be more difficult for the consumer because the consumer has to, kind of differentiate between all these different things. And it seems like the card deck is starting to stack up against the consumer as well, too, in a lot of other ways. Is there any, I guess I'm kicking this one to you, Ron, is there any kind of hope, if you will, for the consumer in 2026 with maybe the tax bill or some of the initiatives that the administration has going on that's going to make it a little easier for the consumer to either make more money, earn more money, or become more resilient in some of these trying times, or times that we believe are soon to be trying if they haven't felt it just yet?
Yeah, boy, that's a lot of questions. So let me approach it from a little bit different angle. So when I did that research on the tariffs and how much is being passed through and what the effects are going to be, I also looked at how long this might last.
Okay.
And that research came back as, the initial impacts would be, 1 to 2 years before the supply chains start catching up. And what I mean by that is you've got such a big push for onshoring with these tariffs that a lot of places are being built, and it takes time to build these manufacturing facilities and warehousing and figure out these businesses are smart. They're going to figure out ways to get around as much of the tariff as they can.
Right.
And so it just takes time for that to happen. So, 1 to 2 years for this initial impact, and which puts us into 2026, certainly. Mm-hmm. But then after that, there's a slowing down of that, and where there's a catch up of the supply chains and what the corporations and businesses are doing to mitigate those effects. And then, within 3 to 5 years from the beginning, then we should be back into a pretty smooth territory again, as long as there's no, crazy retaliation tariffs and things like that.
Now, is there potentially a budding positive wealth effect here where jobs become onshored? We need the supply chain to catch up, but right now these warehouses and manufacturing, they have new employees.
You're saying you need people to build them.
You need people to build them. You need people to run them. You need people to operate them. You need people to manage them. You need people to manage the facilities.
Are we seeing that? Are we seeing that in the job report?
Well, I think it's a little early because 2026 is when the tax benefits actually start. So I don't know that anybody's actually going to break major ground.
But we would start seeing some other leading indicators, right? Like contractual agreements, real estate purchases for those things like that?
Ron, any leading?
Certainly so.
Yeah.
But I mean, at the same time, though, we have this wonderful world of AI where there are huge corporations, Amazon, Microsoft, even these are like AI players that are laying off people in tens of thousands because of the efficiencies that they're getting on that side. So it's a give and take right now.
Yeah, so you're saying it's hard to see. It's like smoke and mirrors right there. It's hard to really see what the net effect is of something. And that's economics as a whole, right? There's so many variables always moving. So when we look at all this craziness and we think about the prices being passed on and maybe jobs being created but also being lost, that again also gives some instability, if you will, and towards what the future could be. The overall thought process is that we should be on an up, right? But I think that there's still going to be volatility. Would you agree? And if so, why do you think that there's still going to be volatility?
Well, what I would say, Tim, I agree with you completely, Tim. It's because you're a real smart guy.
I have smart people around me.
No. So volatility is going to increase because every time there is a change, a paradigm shift, shall we say, people have dislocations, right? We've seen this all throughout history. You know, the Industrial Revolution, the computer revolution, the internet revolution, all these things. And people are dislocated from the jobs that are going away to the jobs that are coming in. And it just takes time for the population to make that shift. And some definitely don't. And I think that's a little bit of what we're seeing now when we look at the jobs numbers, that the unemployment rate is staying historically pretty low. I mean, it's crept up, but it's historically pretty low. But a lot of that is because people have left the job force because they just feel like they can't get a job. You know, I look a lot at the unemployment, you know, the ongoing unemployment, and people that are staying on unemployment benefits, and those numbers are remaining very high.
You know, I was just thinking what you're saying. But go ahead, and I want to respond on a question on a metric that might be interesting to look up.
I was going to say, let's open that one up right after a break.
Yeah, we're at a break. Yeah,
we're at our break point again. We're going to pay some bills with some commercials real quick, and then we're going to answer that one right back. So we'll take a quick break on the Greenlight Retirement Show. We'll be right back. Welcome back. It's the Greenlight Retirement Show. After a quick break here, we want to jump right back into that, Tim. So get us back on track.
Right. So we're talking about the tariffs and it's being passed on to the consumer, and that's creating volatility. And then why is there volatility? Because of something has to give concept, right? And I was wondering, can you measure, like, could because we were talking about the workforce associated with the volatility.
Sure.
We got to that point. And so the question is, if people are leaving the workforce, the 9 to 5, and I kind of have to think this through, it's kind of hard to explain, but could you measure and compare the amount of new S-corps and sole proprietorships that have been made relative to a year where unemployment's at an all-time low and you know, things were, jobs were there, right? Everyone had a job. I'm wondering if people are leaving the workforce, and like you're saying, you're seeing the unemployment rate increase, while at the same time, could we see that they're stepping out and trying to be entrepreneurs? I'm just, you know, people, there's a lot of trend of people thinking about that nowadays.
Ron, you start. I have something to add at the end of that. That's a really good
question.
Yeah, go ahead.
Okay. No, I'm just thinking that's a really good question and a very interesting and in-depth way to dig at that. It makes me think of the transition into the gig economy, right? When Uber and Lyft and all those started up, and all of a sudden we shift, and those people fell off of the data for employment, but they were independent contractors and doing their thing. And I don't know of a really good way to track that, but that would be a really fascinating thing to find out.
I'll take a different angle at the same thing, and I don't have a way to track that, but I want to tie something you said in the last segment to exactly what you just said. What Tim referenced there is people willing to make a change, willing to say, hey, I went to school for this thing that AI took my job for, and I'm going to set that thing down so I can jump into either the gig economy, be an Uber driver. I'm going to jump into, Amazon drop shipping. I'm going to learn a skill. I'm going to try to, with AI and all these other things, the way you can make side money, side hustles, has really been gigified, if you will, where you can just find random ways to make an extra 10, 15, 20, 30, 40, $50,000 a year.
DoorDash, things like that,
All sorts of ways that you can do that. I think the thing that the consumer really needs to recognize in this segment, in these parts, is that you're going to have to make this leap and change. We have historical reference points that say that there's batches of people who were unwilling to make changes, and those people suffered longer.
Well, there's this weird effect. Have you guys ever seen, was the like a Real Player One movie, or the one where everybody was relying on technology?
Okay.
And they all got, everybody was just dumb.
Idiocracy.
Idiocracy. So take an Idiocracy and take a Real Player One.
Ready Player One?
Ready Player One, yeah. I can't believe you corrected me on video games. That's good. So I'm in that mix of video games, and I have to keep my mouth shut. Like, I'm on the chat, and I'm listening, Brian, and it's like a braggadocious thing. Not from my perspective of being successful and saying, yeah, I'm playing video games instead of at work, right? But no, I'm playing video games. I work from home. I can do what I want. I have a side gig. And I'm just thinking, at that age in their life, if they're taking that path, just how successful can they possibly be? And maybe, this is the scary part, their success, and I heard this from one of them, their success isn't the money. It isn't what they can buy. It's their leisure time. And I get that, but that's a dangerous concept. Because as a whole, your economy becomes less productive if you've got a bunch of kids sitting, and kids, I'm saying young 20-year-olds, even 30-year-olds, sitting on their couch, and all they want is ramen and their computer to be fast enough to not have lag when they're PvPing, player versus player, when they're doing that, that's scary. I'm seeing that. And I always said that the gamer and that technology associated with gaming is kind of the indicator. It is, like you have the chats like Discord that's been around forever. Okay, so then Microsoft Teams comes out and Google Chats and all these other things that have chat rooms. I mean, gamers been doing this for a long time. But when I'm hearing that, no, I just want to be able to wake up and get with my guild and go do a raid. And I'm thinking, how are you becoming more successful? Oh, I have a small business. You're not trying as hard. They're losing that ambition and that passion because it's now cool to accept. And I'm not saying money, should be the main focus, but you also can't accept that, it's just everything's just going to be okay and I'm going to take the bare minimum. As a whole, if you do that as an economy, then no one's going out and taking on the harder jobs and producing things and creating value, and we're not having growth. So I'm noticing that, and it concerns me and they don't care.
It's a very real moral hazard.
Well,
for sure.
Another aspect of all these people that are out there doing gigs and side jobs and Instacart drivers and stuff like that is there is a large group of people that are not investing into retirement accounts.
Sure.
And they're thinking that, I'm making this money and it's all about the now. And they're not thinking about the future. And a lot of these jobs that are being done, they're not jobs that you can continue doing when you're 60, 70 years old.
No, that's a great point. That's my point.
Your back's going to be hurting.
Yes.
You're not able to drive, go to the grocery store, grab people's 12 packs of soda.
So not only are you not going to be productive in the economy to help it build because you don't have the skill sets, right? And you don't care. Maybe you have the skill set and you just don't care. You're also going to be a burden on the economy when you're older because you're not going to have the revenue to self-sustain yourself. Because you can't do anything. You're absolutely right, Corinne.
I have family members that are older than me that don't have a retirement account.
Right.
And they're just expecting to, survive off Social Security. And it terrifies me.
Ron, what you got?
That's what I was wondering. Yeah, just right along those lines. I'm wondering what the change in the average age of the gig worker has been over the past several years.
I think it's
they're
trending,
getting older and older.
I think it's the opposite, although, because with the generation the world we live in today, there's a lot of smart retirees. Let's be honest, right? You got baby boomers and all that, and they're doing it just for maybe some extra side cash. What I'm scared about, and what I'm telling you, I'm hearing through the grapevine of what's coming up, is I'm going to do this, and this is my thing because I can take the bare minimum and I can just play video games all day.
Yeah.
Because I can get away with this.
I can get away with it.
Now, can you gigify video games and actually make money? Like
very few.
Yeah. I'm going to become an online streamer for Diablo.
Okay.
Oh my goodness.
I'm just kidding. Back to what we were saying though. In this area, because our household would not survive without Instacart. I do notice that the Instacart delivery folks are often either 60-year-olds that I'm saying you can leave the groceries at the steps, you don't have to bring them up.
Okay, so you do notice that.
Or it's moms who are doing it during the hours their kids are still in school. This Navy community out here, there's a lot of women that are like stay-at-home moms. You get dinner ready, you get the laundry going, and then you go do 5 or 6 orders, make a few bucks.
Well, and that's kind of what it's supposed to be there for.
I think that's what it's supposed to be for, too.
I've analyzed a lot of gig workers' financials, right? And so what I've noticed is it's great for cash flow, but it's not a great business. So let me also help you.
You can't scale it.
And they're putting miles on their own vehicle.
Well, and that's the fail point for most people, right? So once that vehicle breaks down that they own outright and or it goes down for major maintenance, it has a repair bill that's got a comma in it, and all of a sudden you can't afford that. You either have to finance that or you just ditch the car, trade it in for something, but now you have a car payment. So now you're hustling around on this new car. You have even less cash flow because you have a debt service cost against it, and then you fizzle out of that because it's not worth it anymore because you're not getting the cash flow that you're accustomed to.
So I want to bring up something before we get out of this session. We were talking about consumer confidence and volatility of the market, and one thing we noticed is that the outside of the U.S. has been pretty good, and that the dollar has weakened some. Can you speak to that, Ron, as to why the dollar has weakened some in simple terms?
Well, so in simple terms, the dollar has weakened. So it's got about 10% in 2025 versus a basket of other currencies, and it's not insignificant, but it's not a massive crash or anything along those lines. The number one, there's 2 big pieces that are causing that. One is the tariffs. The tariff effect is having some issue there, but the other is interest rates. And so we've been lowering interest rates, and when an economy lowers, any sovereign country lowers their interest rates, their currency will also suffer vis-a-vis the other currencies because people want to put their money in the one that's getting the most interest with the least inflation. So we're seeing that, but in the other economies, Europe and China, these other nations, they're not necessarily doing better than us. It's not that their economic growth is stronger. There's a lot of problems, particularly in Europe, but it's just a matter with the dollar. It's a matter of the inflation effect and the interest rate effect.
So the interest rate and the tariffs.
That's actually helped a little bit.
Because again, just talking to people, we're like 23, 25% less than the euro right now, give or take. And
I don't know exactly what it is.
I'm not involved in the market as much as you guys are. There is a rate change coming up.
Well, there's a meeting next coming up later this December
on the 10th.
Yeah.
And is the goal there to lower it again?
Yeah, because you want to stimulate the economy, and what Ron is saying is that our dollar's not so weak that we have to be concerned, especially if you can get tariffs under control. But our dollar's not so weak you have to be concerned, but it is a factor, which just means the global markets become attractive for investors, which is something that we've done, right? We've started looking at that. And as interest rates come down, we're going to have even more of a boom of an economy. However, it's like dodging landmines because there's a lot of things that could go wrong, right? You've got people get excited, then hype happens. Now you've got AI hype, crypto hype, things like that. And any of those things can have effects on, normal Fortune 500 type of stocks. So it could be be a concern, but there is an opportunity right now in foreign markets, right?
Yes. Yeah, there most definitely is. But you have to be careful. Some people want to say, okay, let's just jump into emerging markets because those are really cheap. Well, sometimes things are really cheap for a reason.
Because they're emerging.
Because
they have
still
yet
emerging,
to emerge.
right?
They have yet to emerge, right? Unless you're like Microsoft, you can get into the infrastructure. You're not. Yeah.
We like to get into things after they've emerged a little bit more. So we have some definites that we can hang our hats on.
I want to be able to see the butterfly.
But, so there's, exactly. So there's opportunities out there, and to Tim's point, a really good point. We spent 15, almost 20 years never touching international.
Yeah, the whole thing was stay away from the international. Yeah, because everything was here. Yep.
Yeah. I would get wholesalers coming in to tell me, hey, you should try our international fund because it's almost as good as the United States market. And that's not really a selling point for me.
Right.
But last year and a half, we started dipping out into that. And so it's been a really good place for us to go. It's been very, very helpful. So good opportunities there.
Yeah.
Good stuff.
Well, that's fantastic stuff. Again, informational purposes only, not investment advice or recommendations. If you'd like to talk more about those, you can give us a call at 757-961-0700. We're going to take a short break here in just a moment, and when we come back, we're going to kind of round up some of these thoughts, give you some great ideas on how you can position things, educational purposes only, but how you could position or consider positioning things for 2026 and the year to come. So stick with us, and we'll be right back. Hey guys and gals, welcome back to the Greenlight Retirement Show. We are almost done for the day today, so we are going to do what you're supposed to do at the end of the year, give you some good ideas for your end of the year planning and some wonderful thoughts for your 2026 start. Tim, why don't you get us going?
Sure, absolutely. I think the first thing we look at is what's hot right now. What's hot, right? So AI is hot. The conversation of crypto is hot.
Yeah.
Right? So now's the time to look at your portfolio, see how exposed you are to those things, and try to maybe reduce your exposure, if you're concerned, to things that are heavily focused around that.
Sure.
What do you guys think?
Right. I think that reducing volatility is always key. And end of the year is a perfect time to look at the portfolio, get a review, and see, am I over-concentrated? Am I taking too much risk?
Right.
Time for that.
Don't want to be following the hype too much is how I would sum it up.
Yep.
Right?
Well, what about gains, though, Tim? I mean, you got to worry about profits, right? It's been a crazy year. Market's been up. What do you do about taxes and gains?
I think most people can get stuck with things like phantom gains from mutual funds.
Oh.
But we pride ourselves on trying to avoid that as much as possible. Ron, you want to give some insight on how you do that? Because you do such a wonderful job of trying to avoid those nasty little phantom gains that get popped out.
Yeah, those can be nasty little buggers. And so what we do is, as we come to the end of the year, we track what the potential gains are from each one of our holdings, and we look at where our clients are and decide, okay, is it worth keeping this holding and taking that gain distribution, or can we sell that and move to something else and avoid that gain? And so we go through that analysis all throughout the last quarter, but particularly here in the last month, so that our clients don't get stuck with having to pay gains on something that they really didn't earn.
Great. I think when we talk about gains, we also think about the other side of the financial plan, which is income, right? You're looking at it for next year. Think about, am I going to have enough income and cash flow? I believe and as a firm, we tend to believe that cash flow is king. So is my portfolio balanced in such a way that I'm able to sustain my lifestyle the way I need to sustain it through cash flow? So am I invested right? And so is now the time to look at bonds? Is it the time to look at more fixed product solutions because I want to guarantee it? But these are the questions you should be asking yourself. If you're going into 26 and maybe this year felt a little tight, if we're talking like we were earlier, that tariffs are going to be reflected on the consumer, then maybe you need to adjust your income a little bit more than what you thought.
Yep.
I did notice with a lot of our clients that come in to alter their income because of the need to cover their RMD requirements. One of the things that I like is that when we're looking at their risk management and we're putting them in portfolios that are still income driven, they're able to take out their RMDs and still see some growth, so their account's not constantly just going down and down and down
Right.
as they
Our
get
goal
older.
is to try to offset it in the beginning. Unfortunately, long term, no matter what our goal is, it doesn't work. But that's a great point. You know, if you're about to take RMDs, now's the time, especially, you know, right here at the end of the year, you might have some time. Definitely get in touch with an advisor and a fiduciary and talk about, hey, do I need to keep taking these RMDs? Is there any way out of it? And the legal answer is, yeah, you do if you keep the same type of account. But maybe a conversion is a conversation to have at the end of the year, right? You can kind of establish, what does your income look like? What were your expenses? Where am I at? If I take this extra money out to convert, am I going to hit the top bracket? You know, most wealthy people reevaluate their tax bracket at the end of the year.
That's right.
That's when you make the moves. That's when you buy the equipment. That's when you do the things that you need to do to mitigate.
And some of our listeners might not know that we do have a full tax firm. We're literally attached to them right now in our podcast room.
On
That's
the other
right.
side of the wall.
So, you know, outside of our financial experts and our market experts, we have people that are experts in the tax field to ensure that the dreams that these guys have to help you with your retirement plans can mesh together with what's legal in the tax field.
You know, that's a great point, and it's deeper than you think, because I realize people listening understand the name Fitzwilliams Financial, but what you need to know, if you want to look up our credentials and you want to look up the company, it's Fitzwilliams Wealth Management is where the money's being managed.
Yep.
I had a person yesterday be like, I couldn't find you guys.
Yeah, Fitzwilliams Financial is not
So
a
we
brokerage.
brand as the parent company, and we have other companies that my wife and I have created as affiliated bodies. But if you want to get the dirty details and all the good stuff, you know, you go right into
Fitzwilliams Wealth Management.
and you can find that on Broker Check or whatever. But yeah, so moving right along.
I wanted to jump in on that. So let's say that I have a portfolio, I have a ton of gains, I got to take my RMD, I got nothing at a loss. What types of strategies, or are there some strategies out there that maybe we could do at the year end? Maybe is there any giving style strategies that are out there?
Yeah, you know, maybe you have some real estate and you're concerned about capital gains, or you're at this portfolio and you're listening to what we're saying. You're like, man, I am not balanced, but I'm scared to rebalance because I'm going to have a huge capital gains windfall, right?
Yeah, maybe you're one of the gold investors who's had a fantastic year.
A great
that's out
run,
there.
right? Absolutely. So yes, to put it, you know, in layman's terms, you can mitigate and do a really good attempt at almost eliminating capital gains if you follow some very advanced strategies and tactics. And that's not for everyone. A little disclaimer there. It requires advanced financial planning and a deep dive into your personal scenario.
Probably a tax attorney.
And we use that. But in the end, can you make a significant impact through charitable giving and still maintain your worth and lower your AGI and basically attempt to delete the capital gains? Yes, you can.
Yep.
And it's not simple. It's complex, but it can be done. So it's something to look into. So, you know, if you're curious about how you can lower your capital gains or how you could get out of some real estate and you want to mesh that with charitable giving and still maintain your net worth, that's a conversation that we can have with you, and we've done that a few times for sure.
Yeah. You've got other vehicles too, like donor advised funds and things like that you can do for charitable giving. Small business owners, a special shout out to you guys and gals that are out there fighting the good fight for yourself. You guys have some grace as well too, because the IRS recognizes that you're going to be running all the way to the end of the year, meeting with your accountant in the beginning of the year. There's actually some things that you can manage with your taxation even in the beginning of 2026 before you even file as well too. So if that's you out there, there's some opportunities to work with our tax team on managing those gains as well too.
And there are special placements too that if you qualify, you can do to get a tax reduction if you have a lot of cash at the end of the year.
Absolutely.
So I think to sum that up, looking at your income, looking at your capital gains and your taxes you have to pay, now's the time to do that. Right at the end of the year, get in touch with the fiduciary, get a review, figure out what you need to do, and maybe you might learn something that you didn't know before. It's hard to research this stuff on your own because it's not a fiduciary thing for someone to just talk about the strategies openly, because you can't do that. So that's why I'm saying things like come in and we can talk, because they exist. right? So if you're just a consumer, you're trying to research, you're not going to find it because nobody who really knows it is allowed to talk about it. It's kind of messed up.
Yeah.
But
right, Tim, that's a really good point because a lot of people are out there pretending they're experts and they're giving really generic, bland advice,
right?
And people are running for it, but it's leading people down the wrong path.
Where folks like us aren't allowed to give that advice openly. So that's kind of the thing. So read between the lines of what I'm saying. Stuff exists, but you need to have a fiduciary. You got to sit down with them and go through it.
Give us a call and come in.
Give us a call and we'll go over it with you. We'll talk to you about all these strategies and stuff. They do exist and they might exist for you. You never know until you try.
That's fantastic, guys. We're going to wrap it up here. You can give us a call at 757-961-0700 if you'd like to talk further about your year-end tax planning. You can visit us at www.fitzwilliamsfinancial.com as well, too, and schedule yourself an appointment. And you can give us an email at team@ffinancial.net if you want to get our 2026 forecast as well, too. But we look forward to seeing you guys next time, talking to you next time. This has been the Greenlight Retirement Show, and we'll check you later. Happy New Year.